Good afternoon, everybody. We really appreciate everybody coming. We realize that particularly after the hurricanes, everybody's got a lot of time constraints. So to see this group take, a day and a half out of their time to come visit us and learn about what we're doing is really gratifying. So we really do appreciate it. As Joe alluded to, we're actually in our 11th fund year. We actually started the first conference the first year. So this is actually our 10th conference, even though we're in our 11th year. Probably a third of the group had actually made it to the hotel last year when Matthew was ping-ponging, and we literally pulled the plug at the last moment when we figured it could possibly hit. So in celebration of the 10 year, there's just a few folks, because I don't think when I've given this presentation over the years, I've ever actually singled out people that have been integral in getting us to this point. So the first part is our first year, the exact number of members was 31. So this was 2007, 2008 fund year. We ended the year with 31 members, and hopefully the good story it tells is many of these 31 people are here today. I would say a good 10, 15 of them. And of the 31, 20 have been continuous members for all 11 years. So if you look at that, that is essentially a 1 member a year loss, which is a 1%. If you do it on a percentage basis, it's about a 3%. So that 97 over the past 11 year retention rate is something that we count on. It's something that we need from you and we offer to you, which is the stability. So hopefully, thank you to the people that have been with us for 11 years. We're glad to have the new folks, but I think it's the folks that have been here that I encourage anybody that's new. I mean, literally talk to anybody in the room, because everybody's got the same story. That's the reason we get together and do this, so everybody has facts. And my singular goal for my little presentation, and it's going to be about 45 minutes, is I'm going to tell you what I think you want to know about FIT, and then at the end, we're going to open it up, and you can ask any questions you want. Nothing is off the table. Secondly, there's a few individuals that I think most people know them, but 11 years in and having grown as much as we have, I've never publicly said thank you to them. So obviously our trustees, Joe Anello, Jim Weeks, and John Cherry, they get no compensation for this, folks. I mean, they even pay their own travel. Certainly there's a self-serving function, which is they're serving their organizations. But there's an awful lot of work that goes into administering one of these things, and those three folks give a lot of their time. So we really appreciate it, gentlemen. And then the NPIS team, I don't know exactly, but if you include the loss control people, underwriters, and claims, that team's something north of 20 people, but there's 5 that started it, and they're still with us. And those folks, I think, are all in the audience. Doug Childers, Sr., we affectionately refer to him as Face, because when we were putting this thing together, you got to put it together behind the scenes, and somebody still has to ping pong out there between people. So Hasib Bangloria, which I think most people have met Hasib, he essentially runs all the operations of the Florida part of Ballator. Peter Heron Brown, who is our MC today, and he introduced himself. He started out as the lone underwriter. He now heads a underwriting team of, I think it's 5 people. Jennifer Lister, who's here in the front row. Jennifer has been our, again, much like Peter, started out as kind of our one-person resource for claims and loss control, and has now grown into heading up a team that does that. And Broderick Baldwin, he heads up our accounting department. And again, all these folks have been here, and when you're doing something like this, you have to have stability. And I just wanted to point that out, that since we started, the members have stayed, the teammates have stayed the same. We've had quite a bit of growth, but as Joe said, there's certainly in pooling some benefit to growing. The first thing I'd like to address is, I think most people in this room prior to joining FIT or hearing about FIT had probably never even heard of insurance pooling. And it kind of sounds all hocus pocus until you realize that in insurance, for the first 3,500 years of the first 3,500 years of insurance, there was nothing but pooling. It actually goes back, believe it or not, 3000 BC. In China and Babylonia, you had merchants who had ships, and when you lost a ship, you were in real trouble. So 10 of them got together and said, you know what, we'll each split our loads between 10 ships, and then if a ship goes down, we're not completely gone. There were various forms of that for the next 3,000 years, and it wasn't until modern insurance started at Edward Lloyd's coffee shop, which of course I think most people know is now called Lloyd's of London. What I don't think most people know is Lloyd's of London is not an insurance company. Lloyd's of London is a pool. It always has been a pool. Now, it's a very large pool. In fact, it's the largest pool in the world, but it didn't start that way. But a lot of the terminology that we use, so those same merchants, they would get together at the coffee shop, and somebody got the smart idea and said, we don't have to physically move the loads. We can make each other responsible contractually. So the term premium and line slip, all those things came about 500 years ago. And what would happen is a merchant would tack up a sheet called a line slip, and who better to know, so let's just say he was taking a load of wool to Athens. Who better to know what the price of risk is than the fellow merchants that are doing the same thing? So he'd tack it up on the wall, and the other merchants would come by, and they would just sign their name to it, and they'd put a percentage. And obviously, when it gets to 100%, you're doing the same thing. You're spreading the risk, but you don't have to physically move wool from one boat to another one. Benjamin Franklin started the first insurance pool in America. He also started the first fire department. He was a very industrious fellow. So this one is the first part that's considered loss control. If you paid him a premium, he would give you a watermark that you put in front of your residence or your business, and his fire company, if your house or your business caught on fire, would come to your house and put out the fire. If you didn't have a watermark, he didn't come put out the fire. He was a pretty smart fellow. The first commercial insurance companies, and listen, we do a ton of business with insurance companies. Insurance companies to us is not a bad word. It's just a different type of mechanism. But the first commercial insurance company began in about the 1800s, so they're about 200 years old. And even today, there are large classes of business, most notably all of the city, county, and state municipal business around the country that 90% purchase from pools. So I just wanted to give everybody a little bit of perspective that just because this particular group hasn't heard of pooling, pooling is still one of the largest firms of insuring in the world, and it's been around for 3,500 years, longer than any other type of risk transfer. Wanted to talk a moment about the different lines of coverage, kind of give you a very high-level overview of what we're currently thinking has happened in the market and maybe start setting expectations. I think one of the things we really strive to do is keep our insureds informed around the year. If there's something that's going to be bad news, you can be assured that we're going to tell you as early as we can. And obviously, we just, the last 2 nights, we had our London guys, we had meetings here. And so we just got some real-time input as to what the markets themselves are saying. And the first thing to consider on property is property, the catastrophe property, is truly a global market. So, I mean, obviously to us here, we're worried about southeast hurricanes, but it's the same 15, 17 carriers that provide insurance here, that provide insurance in the Caribbean, that provide it over in Japan and South America. So when you look at it from that standpoint, it's really worldwide capacity that counts. And for about the past 3 years, in the United States, we've obviously, up to this year, we've had a 10-year pretty good run in Florida. We haven't had any California quakes. But the rest of the world, each of the last 3 years, stopped somewhere short of 100 billion in total claims. And that's kind of where the market capitulates. Out of about 100 billion in claims from all around the world, the insurance companies have essentially lost all their profit for the year. It hadn't gotten into their capital base yet, which is very important. But the higher you go over 100 billion, that's when you start them losing their capital base, and certainly they're going to want to recoup that capital base, which means increases for all of us. We are on a record year for property because of all the hurricanes that we've had, the earthquakes down in Mexico, the fires up in the northwestern part of the country. The estimates are we're already north of 100 billion. Now, and I wanted to just clarify something for you. It's really hard, I think, for somebody who's not really involved in the insurance business. there's all types of different losses, and the ginormous numbers that you hear, the bigger the number, the better for TV ratings. So each one of these hurricanes, there's published that saying it's going to be a $100 billion event. That's an economic loss. That is not an insured loss. These insured losses in the United States, I do believe, probably total $100 billion. But when we start talking about these numbers, if you hear something on TV, big numbers sound sexy. So there's a lot of different numbers. These are insurance companies paying out $100 billion in property losses. This was my opinion. I put this together a few weeks back. I can tell you, the London guys who were just here, the pricing indications, I think the standard market, if we don't have any more storms, and as everybody knows, we actually have one coming up to the Gulf, would be a +5 to +15% as far as premium. The pooled market, we should be able to be flat to maybe a +5. Now, obviously, we've still got several months left in the year. Most of the reinsurance treaties come up January 1, so a lot of this is prognosticated upon the fact that we have no more major, because the storm that's coming in looks like a Cat 1. It should not be too bad. Just to give you an idea, this is 2016, which in the United States was actually a low loss year. And this is color coded. I know you probably can't read all the detail from where you're at, but essentially it's color coded by type of catastrophe, and you got tsunami, and you got fire, and you got hurricane, you got hailstorms. So they each have a color code, and then the size of the dot corresponds to how big the loss was. And so if you look at 2016, you had major ones in Canada, South America, Europe. We had a tsunami over in Southeast Asia. So again, this all erodes it's the same group of people, and to keep it under 100 billion is the key for us. On commercial liability, this has really became a hot button nationally over the past 2 years. Commercial auto liability, back when I first got in business, was always a big problem, and then all of a sudden the race team to get adequate. Over the past 3 years, the whole universe of auto insurers have announced staggering losses. Over the last 2 years, people have seen their pricing go up between 10 and 25%. Was just talking to a couple of the brokers in the room that said that they're still looking at out of the standard market somewhere in the 15% increases. Our auto experience, although we've had a couple of big pops, has been very good. I don't think we will need nearly that. The rate increases, I mean, it just comes from poor underwriting results. I mean, you see all the advertisements from both the personal and commercial auto carriers. It's hyper competitive. And the carriers write it, and they just can't withhold the losses. Both Liberty Mutual and State Farm, who are two of the largest insurance companies and auto carriers in the country, each of the last 2 years have announced multi-billion-dollar losses. Well, obviously, when you get the biggest carriers in the market and they're getting multi-billion-dollar losses, something is going to happen with pricing. This is really where the pooling mechanism comes in and levels things out, because our price is going up. I know for certain we're going to get very good support from the market. We're certainly better marketing all of our insurance together. But I mean, I can tell you as we sit here, we're going to get an increase, but there'll probably be offsetting decreases in other lines of coverage. And the deterioration is really based on a myriad of factors, but the two big ones are distracted driving, which 10 years ago didn't really exist. And I know I've got 3 teenage kids, and I know how that can be. And the other one is this new technology, which in one sense keeps us really safe, but every car now has lane avoidance and the stopping and automatic. Well, what that did was that took a $1,000 fender bender and made it an $8,000 fender bender, because they have to replace all those electronics. So those are the two big. There's some other factors in there. The growing cost of vehicle repair, the increased traffic, I mean, that all plays into the poor underwriting results. But the two big ones are the distracted driving and the technology in the cars. State of the market for GLPL, which is general liability, professional liability, and directors and officers. So essentially, the liability coverages that you have. The experience on this one, the underwriting results nationally have actually been pretty good. It's a pretty robust market. There's a lot of options out there with good prices. So I think everybody's going to be pleasantly surprised with their GLPL D&O this year. The thing that I caution everybody on is this is a line that is not regulated by the state. A lot of the coverages, like workers' compensation, is statutorily required. So everybody's essentially the same. Workers' compensation, there are some differences, but it's statutorily required, much of it. General liability, that's not the case. So the coverages that you get, the terms and conditions can vary greatly. So obviously, every year when we come to you, we point out where we've improved the program. And again, we will be doing that. Now, the employment practice liability, this is one that we've actually, I think the last time that we physically met 2 years ago, we ran a whole session on this because it was getting so big, and probably a third of the people in the room had some sort of employment-related claim during the past 24 months. That trend has continued. Both the number of claims and the dollar amounts of the claims continue to increase. So that's one. If everybody doesn't know, FIT maintains an 800 number with an employment attorney that is free to all of our members. So if you're getting ready to fire somebody and you haven't done so, please pick up the phone, give them a call, just tell them the details. It costs you nothing. You don't have to listen to their advice. It's just free advice. We found that getting ahead of the curve on these things is all about the outcome. So please utilize that 800 number. Workers' comp. Well, I modified this one. Last year, there was a lot of information on workers' comp last year. So we had 2 Supreme Court rulings that radically changed the work comp system in Florida. The largest one had to do with attorneys' bills, and it rolled it back to the pre-2004 statutory change in the work comp statutes. So as NCCI early last year announced a proposed 20% rate increase, everybody went up in arms. The state ultimately approved a 14.5% rate increase, which went into effect December 1st of last year. NCCI has now came out and is proposing a decrease for 2018. But number one, the state has to approve it, and usually the state doesn't accept what NCCI proposes. They usually temper it. So the proposed decrease sounds really good at this point, but we got to see what the state adopts. And then the other thing is, when they announce a 14.5% rate increase, that doesn't mean that everybody's going to get a 14.5% increase. There are hundreds of class codes. In aggregate, they make that up. So indeed, when NCCI proposes and the state accepts an increase, our particular codes could potentially get a decrease. So we're a little bit premature. I do think there's probably some savings to be there. The world hasn't fallen apart like a lot of people thought versus the Castellanos decision, which is the Supreme Court decision with regard to attorney's fees. So this is a market in flux. The nice thing about FIT is the only carrier in the state that's formed under a statute that allows us to have variability of rates, meaning our charge to any member is based on their experience and their exposures. Florida is the only state in the union that mandates that standard carriers all use the same rate. So there's really no competition as far as dollars, because the simple decision that the carriers have is, will we insure this entity for this price or won't we? We have the ability to sit down with you and say, well, what can we do to avoid some of these claims? And we've got the ability to flex pricing as appropriate to the individual accounts. The benefits of pooling risk. Stability of pricing. I mean, that's the number one thing. You've heard Joe say it. I said it when I first come up here. We understand we got to be competitive, but the stability in pricing, and I've got some examples of some losses coming up that shows that stability. Customized services, I mean, I think everybody has hopefully used our loss control portal, our loss control systems, our claims folks, who are all geared specifically towards the types of operation that all of us in this room have. I think the part that is easy for everybody to get is just the spread of risk. It's unlikely that a lot of agencies are going to have poor experience in the same year. With the number that we have, guaranteed, we have several big pops every year, but they come from different members, and we're able to stabilize the pricing because of that. The cost savings over conventional insurance, I've got a slide that's coming up here shortly, and I'll show you exactly why FIT can be more cost effective than any other insurance company out there. Group purchasing provides better leverage with the carriers. It's certainly going to hold true on property this year. The property carriers, we don't know to what extent they're going to really try and push pricing. Well, we're going to push back with a very, very large leveraged number. And obviously, if you have a larger number, you have more ability to controvert what they say. The convenience of purchasing all your insurance from one cost competitive company. We know that your guys' staff wear a lot of different hats. Our goal is to take that risk management function off them so that they can focus on the other stuff that you have them doing. And we offer a very cost-effective, and I think most everybody's taking advantage of this, but we do understand that cash flows to you guys and predictability of cash flows are extremely important. So we offer for all lines of coverage 12 equal installment plans that we negotiated for the whole group as one at super, super competitive rates. So those are just some of the benefits of pooling in general. A few things that didn't really fit into any category that I would think that you would want to know about FIT. We are the only trust of this type, and we have been. The regulatory hurdles to start one of these things are so high, it takes a multi-year effort, and you have to be able to put the thing together and hold it together while you gather the membership, which is very difficult. We are governed by a board of directors who are members, Joe, Jim, and John. We have to submit an annual filing to the Office of Insurance Regulation, so a lot of people, if there's any question about us, just call OIR. We have a very, very good relationship with those folks. We have to give them audited an audited financial, an actuarial statement of rate adequacies. There's a whole packet that goes to them. Our filing goes to the state on or before November 1st. We usually are about a month early, so our audit is ongoing right now. We'll turn our financials, which we're going to talk to in just about in a second. The coverage available, in short, it's essentially anything you purchase. There are some allied lines out there that we don't, that we will typically, your agent or us will typically place outside. But your auto liability, your general liability, your professional liability, your property, your workers' compensation, so all of those lines are now available. The FIT service providers, NPIS being the administrator, we're the one that puts this event on. We're the one that's out there on the front line. But we always think that you should judge an organization by who they do business with. And these names, if you are not in the alternative funding insurance business, are not big, big names. But if you live in our world, they are the best of the best. Larry Shores of Shores, Tagman, and Butler, they have over 100 pools they prepare audits for every year. The administration, that's us, NPIS. We have an independent actuary, casualty actuary consultants out of Nashville. Again, they specialize pools. They do over 125 of them. They're exceptionally good at their job. The law office, Brennan Law Office in Tallahassee, if you guys haven't done business with them, they do nothing but insurance regulatory law. And then the claims administration and loss control, of course, that's York, formerly FARA, and they've got an office in Boca Raton, and they do an excellent job of expediting the claims on our behalf. This is an interesting one. Why doesn't FIT need as much premium to cover the risk than a standard insurance company? And it's really simple. It's three things, really. And the first one is it just squeezes all the fixed expenses. The administrative cost of FIT is 10% of the written premium. If you take an average of all the insurance companies, their average administrative cost is 16%. That's a 6% savings off the top. And then if you look at the commissions on work comp, we pay 6 versus the industry pays 10. On the package and liability, we pay 10 where the competition and standard companies charge 15. That's, people ask us all the time why we only work with a limited, dedicated set of agents, and it's really two things. Number one, we need somebody who really specializes in this because we need them to be able to explain our product, the positives and the negatives, so that we can have an informed buyer, so that when somebody's a member, they understand what to expect. And then secondly, they really have to have a long-term view because, and this was something that we dealt with for years and years, to move an insured over to FIT cost agents money. So they have to believe in the long run that they're going to write more business for a longer period of time, because on any individual deal, we're just taking every fixed cost and squeezing it down. The industry specialized claims handling. Over history, this surprises a lot of people. Over history, insurance companies have made 100% of their profit from investment income. So for every $100 an insurance company takes in, they plan on paying that $100 out, but they're going to pay it out over a 7-year period. And compound interest is an amazing thing. With this class of business, that actually does not work. We close claims out exceptionally fast, and I'll be asking you guys individually to see how we're doing, because we want to make sure we're actually living up to our promises. But I mean, we have virtually no legacy claims. We close out, and we can look up the statistics, we close out claims about 30% faster than an insurance company, which means we're not making it on investment income, we're making it on an underwriting profit. No compensation for the board of directors. Doesn't sound like it'd be a big number, but if you pick up any publicly traded insurance company, you can pull out their blue book and look it up, and there's huge numbers that go out to the board of directors. Luckily, we have 3 people that like to work pro bono. And we provide all line coverage with lower operating costs. This is, I had mentioned this earlier, which is on any given year, if you're running an entity, you could be the most well-run entity in the world, you're going to have losses. If you didn't have losses, you wouldn't buy insurance. But the odds of having bad losses in multiple lines, so I'll give you an example. If it's split up, and we've really been pushing hard to try and have everybody be on a package, because there's a savings to you and there's a savings to the pool. But if you have a work comp carrier and you have a bad year in work comp, you're going to get an increase. If you're with FIT and you have a bad year in work comp, but you're good on the other lines, you're absolutely fine. Again, that gets back to that stabilization and normalizing the premiums. This is an interesting slide. A premium analysis after a major loss. So member 1 had a loss in year 3. And by the way, not only are these 2 examples real life, they're sitting here in the room pretty close to me. I can't see that far, but no, member 1 had a loss in year 3 with total incurred of over $1 million. So this is what we wrote it for. The second year they got a decrease. The third year they got another decrease. In the third year they had $1 million loss. We had to give them an increase. We're still less than they were in the first year. And then by the 5th year, it's going back down. Very similar situation. Member 2 had a loss in year 2 with total incurred of $689,000. So if you look at this, this is what we wrote about. That we had some savings the second year. They had a big claim. Again, it did not go up, but it's still not as high as it was in the base year. And these are just 2 examples. I could give you 100 examples of how this actually works. Why should an organization purchase all lines of coverage from FIT? It does provide greater stability. We've already discussed that. The dedicated service team, we've discussed that. The package credit, because the trust is much more profitable on all lines of business, we give a package credit, much like you hear all the insurance companies trying to do. The autos are saying package your home and auto. This works in much the same way. Eliminates the potential for claims conflicts. This is one I can't possibly understate, particularly with this class of business. we have a lot of claims that can either be both workers' compensation and auto liability. We see a bunch of them that are auto liability or professional liability. So if you have an employee that gets in an accident, an at-fault accident, we're on the hook for the auto liability. We're going to pay work comp out on that. To avoid the conflicts, if you buy all coverages from one carrier, you don't have any conflicts. A real-world example, an auto liability, so you have a patient who's in a wheelchair, we got one of those lifts outside the van, and you're putting them down, they weren't properly secured, they fall forward, this was a claim that we had. Is it auto? It was involving an auto, but it wasn't involving the operation of an auto, or is that professional liability for lack of oversight? Well, you don't want to be put in that position to try and prove it one way or the other way, or where the insurance companies start fighting trying to prove the other one was responsible. You guys just want to turn it in and say, call it whatever you want, just make sure the thing gets adjudicated properly. Those are some examples of multi-lines loss. And of course, I'd like some feedback, but I mean, I do think the 12 equal installments is beneficial for everybody as far as their budgetary and planning. Some financial highlights, and it's a little bit difficult in this format, so I'm going to hit some highlights for you, but obviously our financials are public information and we'll give them to whoever we want, but the number one thing that we focus on is claims paid and processed to date, which is just about $75 million. That was as of 6/1/17, so that doesn't include anything from this current year or the hurricanes. I would venture to say by the next time I do this, that number will be up to about $100 million. On financial summary, this is our P&L, and I'm sure it's hard to see from back there, but the highlights are the audited year-end 16 revenues were $25 million, so revenues and premiums are the same thing. 25 and some change, that grew to $33 million over the past 12 months. The carrier expenses, this is how much, obviously, the trust relies a lot on excess and reinsurance. So the amount that the trust actually pays for insurance went up from $8.2 million to $11.8 million. That's about proportionate with the premium growth. The big number on the board is the loss and loss related expense, which only went up from 11 million to 13 million, much lower ratio than the premiums. The underwriting expenses, so this is taxes, fees, agent commissions, administrative costs, the pool expenses, the actuarial fee, the audit, all of those increased from 5.1 to $8.3 million. And so the all-important bottom line, our last year audit showed that the trust turned about a $50,000 profit. This year, by the time the audit comes out, this is probably a little understated, we're going to show a $75,000 profit. The pool, the board has a stated goal of growing the surplus between $50,000 and $200,000 every year. For the financial stability of the pool, we do need to continue to grow the surplus base. However, even though, and this is something we're working on, even though the pool is made up of nonprofits, under federal tax law, the pool itself cannot be a nonprofit. So we actually pay taxes. So if we show too much profit, we're just paying it to taxes and it's not going to the benefit of the members. That's why we have that strategic goal of keeping the surplus growth standardized. The balance sheet, I'll just hit the highlights. It's pretty simple. We got 16 million in assets. Of that, cash and cash equivalents are right at $10 million. Now that interest rates are going up, we have a presentation coming up shortly talking about the economy and what's happening with interest rates. We're going to get more aggressive in investing. To date, we've actually done better having the deposits offset the fees from the banks than earning the interest. There's only two other big numbers on the board. One is simple. We are an agency bill, which means for your insurance, the agent bills you, they collect it. About 30 days later, they remit it to us. So any given month, we'll always have $1 to $2 million. That's a receivable from agents. And the same thing with the insurance companies. We're paying claims on their behalf, but it's usually about 30 days before we true up with them. So we have two receivables, one from agents, one from insurance companies, and those account for 90+% of the assets. And then the liabilities are really simple. I mean, what we really promise is the ability to pay your claims when they happen. And so the unpaid losses and loss adjustment expense is 15.1 million. There are some small amounts of service fees payable, but essentially the total liabilities are 15.4 million, which leaves us a fund balance of $1,069,000. One misnomer that the standard insurance companies always try and use against us is they don't have much surplus. Well, you don't pay claims out of surplus. You pay claims out of reserves, and that 17 or 18 million dollars is all sitting there to pay claims under the retentions, which are very narrow. It's a little bit easier from back there to see stuff graphically. So the number of members, we go back to '07, but it started getting the chart getting a little crowded. So you can see that the growth has been pretty linear. And the same thing on the written premiums. It's been fairly linear. In '08, we ended up at about 5.2 million, and we just finished just shy of 35 million. In fact, the run rate that we set at today, we're closing in on 40 million. And again, these things, if they get out of whack and they're not looking the same, it could be problematic. But the claims incurred, again, have grown every year. We did have a very good year in 14-15, and the surplus has gone up each and every year to the point that it's north of $1 million. This is our excess structure. I mean, when you ask who's paying the claims, I mean, the claims are being adjudicated by our dedicated claims team at York. The fund is paying for claims under the retention, but these big boxes, this is the liability, which is Markel, which Phil Frieda is here, who supports us very much on those. They also do a buffer layer on work comp that retains $150,000 per line. So when you talk about the ability to pay claims, you got to look at our financials clearly, but you really need to look at the financials of our carrier partners. And then on the property, I think they had to leave, but our lead Lloyd's underwriter was actually in the last 2 days. We had good meetings with them. But Lloyd's is our primary, and then we build up to a $100 million loss limit, which Haseeb's going to have a presentation talking about property and claims here in just a couple sessions. So here's the folks that we rely on for big claim payment. Markel's on the work comp and the auto GL, cyber. Lloyd's is on the property, and RSUI is on a particular part of D&O and EPLI. And if you look at those best ratings, a lot of people hear of them and probably don't understand what they mean. It's a letter that a number. The letter denotes what best thinks of the management of the company. So obviously, A is good. The number is based on the size, simply on the size of the company based on statutory surplus. So an A15, which Markel is and London is $2 billion or greater. So both of those organizations have more than $2 billion in reserves to pay claims. This was something that we had before the storms even came in. We're always looking to improve the coverages, get additional coverages. So not only do we want to be the most price competitive, we want to certainly be the broadest coverage for them. And this is a map of Florida, and last year we were able to rework the wind deductibles, which worked really to our favor. Before we were at a 5% and a 3% based on the location. We got that changed to, we got the 5% taking down from essentially Tampa Bay on the West Coast to 3%, and we got a lot of the inland stuff moved to 2%. And as you guys are going through and figuring out what are the limits of your claims, how much claims do you have, take the TIV, the total insurable value at that location, and see what the difference is between a 2 and a 5% deductible. It's a huge number. So that's one of those things that, unluckily, we're probably going to get some real world examples. We'll probably talk about this next year at this, which is the difference of where the deductibles are based on where you are. This is one that the folks that have been here before, I've kept the same 3 examples of a loss for at least the last 5 years. So this was not, it's funny because it sounds like Irma, but this has been 5 years. So a loss scenario, Category 4 storm makes landfall in Dade County, goes directly at the center of the state. 50 FIT members are suffering total losses of 75 million. FIT pays 0. We have excess protection for that. The property carriers pay 75 million. Frankly, we actually thought that if that kind of scenario came true, that 75 would we have enough? Thus why we bought 100. Now, maybe we just got lucky on this one, but the IRMA losses at this point look like they're going to be somewhere, the losses to fit, somewhere in the 5 million neighborhood, which is exceptionally good. We got 100 million. The IRMA loss is going to be somewhere around 5 million. Scenario 2, a member was involved in an auto accident. The driver of a van carrying 4 clients crosses the median and collides head-on with an oncoming car. The driver of the other car, as well as 3 of the clients, suffer severe injuries. $1 million in damages are awarded. In that case, FIT would pay its $150 retention, and the auto carrier pays the other $850. So again, this is getting back to where is the financial security? Well, it's in our excess and reinsurance carriers. Law scenario 3, an employee of FIT member claims sexual harassment by a supervisor. The employee files a suit against the member as well as the member's board for its hiring practices. The suit settles for $400,000. Again, in that case, what comes out of the FIT coffers is $150,000. The professional liability carrier pays $250,000. Some of the stuff that we discussed at the last educational conference we had 2 years ago, at that point we had just initiated the package credit. It's been wildly successful. I don't know the exact numbers, but the number of people that we provide true packages on at least quadrupled. If you take the average saving to those members that went from a single coverage or 2 coverages to all lines coverage, the average savings was 12%. 2 years ago, cyber liability was just coming out. We provided cyber liability. About 20% of the membership took it. We actually just recently saw our first claim on that, so it was interesting to see how that was adjudicated and how those claims can come. I don't know enough details to give you details on it yet, but I will certainly follow up with everybody. No surprises. This was one of those things that 10 years ago when we got people together and we said, what are the most important things? Well, price obviously and service, but one of the things was no surprises. A lot of standard carriers provide quotes a week before the renewal. Nobody can make a good decision on something this complex in a week. So I mean, we've promised it the last 3 years and we've delivered on it. Everybody in the pool got a renewal at least 30 days in advance. Budgetary guidance, we usually go out in February. So there should absolutely be no surprises. FIT obviously is a part of the social service world, and so we try to do our part. And at this point, we are providing members and associations in excess of $200,000 a year. And those are several of the associations plus participating in a lot of y'all's fundraising event. Regional workshops and webinars around the state on topics of interest. We've done quite a few of those. They've been well attended. Thank you very much. We'll keep you abreast. And then the FIT manuscript coverage document provides superior coverages when compared to the competition. We're going to talk about what some of those coverages are, but this particular hurricane is going to give us a real world example of where those coverages are valuable and the dollar value they are. With that, we have the perfect fit. I would love to answer any questions on stuff that I didn't actually touch on or any questions that I did touch on. Yes, ma'am.
You mentioned that the fund balance was about $1 million. I assume that if it stays that's moved into the reserves and at the end of the year, or does it kind of stay there?
It's a balance sheet item, and the reserves, which is that $16 million number, that stays. The surplus is money over and above that. And so each year, when we collect premium, the reserves go in there to pay the claims, and we drop some additional money into surplus, which is additional money over those reserves.
So did you address what the surplus is currently?
I thought I did. I'm more than happy to go back, but it's I think it was $1,069,000.
Okay, I saw that. I just was thinking it was a bigger number.
No, the reserves are the big number because that's what we pay claims with.
Okay.
And I joke around about it with the trustees. I mean, the analogy that I always use is if you try and compare our financials with a publicly traded insurance company, it's apples and oranges because they're paying all the claims out of their pocket. We are not. And I know we have several Goodwills here. A good analogy is if you compare a Goodwill's financials with that of a big retailer. Sears, Kmart, they look terrible. Now, does that mean that the Goodwills don't have enough money to do their job? It's a whole different world. You're comparing apples and oranges, and that's why I was trying to give everybody a base and talk about the excess and reinsurance, because those are the ones that pay the big losses.